welcome to the Euromoney Conference, our first keynote interviewee, who is, as you can see, Sofie Blakstad. Sofie, welcome. Great to have you here. First time in Doha in 20 years, I understand?
That's right, thank you. It's great to be here again. In fact, it's great to be anywhere after the last 2 years. But
particularly
yeah,
here,
fantastic.
obviously. Has it changed in 20 years?
It really has, yes.
Yeah, unrecognizable. So we have 32 minutes where we're going to talk about a small subject and not a very complicated one. But Sofie is, amongst other things, as you can see, the CEO of hiveonline, but is a long-time technologist, financial technologist, and an author and commentator. And we're going to talk for a while about the blockchain, stable coins, and something called CBDCs, which I'm sure all of you know what they are, but those of you that don't know what they are will know inside 32 minutes. So Sofie, just very quickly to start with, could you just say who you are? I mean, talk to me about yourself before we look at terrifying charts.
Okay.
Let's just say, so, what is hiveonline? Who are you? Where do you come from? That type of thing. Let's start there.
Thanks very much, Richard. So I'm Sofie Blakstad. I'm the CEO of
You might need to be a little closer to
a fintech startup called hiveonline. We are the first decentralized finance startup for Africa, for rural Africa in particular. And we support people who don't have access to financial technology by building alternative infrastructure using blockchain. We support people who often have no exposure to technology and have never used it before, so we're really at the frontier of the markets. My background is in building international banks. I've worked for 8 international banks and built financial technology and infrastructure in over 60 countries, including quite a lot in Africa and indeed the Middle East. When I was at Citi, this was in my region. So yeah, it's really great to be back here again.
So when did the word blockchain first enter your consciousness?
It was probably around 2011, 2012, when I was just transitioning from Citigroup to another bank. And at that time, it looked like a bit of a flash in the pan. But after a couple of years, and especially as smart contracts came along, I began to understand the potential to create financial infrastructure where none existed. And that for me, having had 13 African countries, Russia, Kazakhstan in my portfolio, and having delivered infrastructure into these countries, I really saw the potential to reach out to places where traditional financial infrastructure didn't reach.
Excellent. So let's start with what, as I think everyone will, I hope everyone here will know, there's been a little bit of a thing going on in the crypto market. Could you talk about that thing?
I can talk about that
which
thing.
is my favorite slide, I must say already. We start with the best one. Blockchain for stability, and then 3 question marks. That's not a chart anybody wants to see, really, is it? I mean, that value going to naught over a very short period of time. So just say what's happening in the markets now and why, and what does it mean for the wider adoption of the technology?
Sure. So blockchain is a technology that is still relatively immature in terms of regulation and in terms of how consumers understand it. And what that means is that there are quite a lot of blockchain-based products out there, Terra Luna being an example, which may not actually be terribly well designed or terribly well structured. We saw this with Tether, the USD denominated stablecoin, which was supposed to be 100% backed by US dollars reserved and wasn't. But because of limited regulations and limited scrutiny, they got away with what was effectively a fractional reserve. Terra's stablecoin, which is linked to the Terra Luna, which you can see the chart.
Looks more like an unstable coin, isn't it?
Yeah, I mean, this isn't actually their stablecoin, it's actually their base currency, but the stablecoin had the same trajectory.
Yeah.
The problem with that was actually it was just badly designed. And at some point, a couple of weeks ago, the algorithm decided to issue a whole lot more of the stablecoin, which basically destabilized the stablecoin. And this is what we call an algorithmic stablecoin, which is programmed to track a currency. And there are different types of stablecoins. Some really are backed by 100% currency, and those are the safe, boring ones. Some, like Terra, are not backed by anything, but are just programmed to track another currency. And some have a reserve of some other type of asset.
I mean, you've used a lot of terms, words in that in what you said. Could you explain to me and to our audience what the difference in all these different things is, and particularly now the one on the right-hand side, as we're all looking at it, which is CBDC. So what is a cryptocurrency? You've talked a little bit about stablecoins, but how does that relate to a CBDC?
So the difference between a cryptocurrency, a stablecoin, and a CBDC is effectively what is sitting behind it. A free-floating cryptocurrency like Bitcoin or Ethereum or Ether has nothing behind it except the technology and the faith of the market, and that's why they're so volatile. A stablecoin, by contrast, is supposed to have some kind of backing. And as I said, you get different kinds of stablecoins, some of which are backed by boring old currency reserves, 100%, and they're the safe ones. Some are less safe because they're backed by other types of assets, often digital assets. But a CBDC is, in many ways, the safest of all because it's backed by the central bank. So a central bank digital currency is issued as a liability on the central bank's ledger. So it's just like cash. Now, that has some interesting characteristics, and we'll go into those in a minute. But one of the key things to know is that it's not issued by a bank in the same way that normal bank-issued money is. So you're not operating on fractional reserve, you're just literally operating off the ledger of the central bank.
So if we go from left to right on this slide here, is the implication that you're getting, as it were, safer the further to the right you go?
Absolutely, yes. And any kind of digital asset, it's very important to divorce the technology from what's underpinning it. We've also seen a lot of publicity about NFTs, non-fungible tokens recently, and about the volatility of some of those. But actually, that's not to do with the technology so much as what's underpinning it. So if I have an NFT for a tree, a cashew tree, which will produce 100 kilos of cashew over its lifetime and has a terminal value as wood, the value of that tree is fairly predictable. Whereas I have an NFT that is representing Jack Dorsey's first tweet or some piece of digital art. That's volatile in the same way that those assets are volatile. It's nothing to do with the tech, which is different from the volatility caused by the Terra tech glitch. But yes, absolutely. As you go to the right, the more solid the assets underpinning the digital asset are, the safer the digital asset is. And anything that's issued from the central bank carries the same risk as that central bank's issued cash.
So why would I ever choose to use a cryptocurrency if I had a CBDC instead? Okay, that's one question. Without going into too much of the rest of the presentation or the rest of your slides, but what I'm trying to get at is, what's the use case here for each of these different things, and why would I not want a CBDC if I could have one?
So a lot of the original philosophy behind cryptocurrency was the decentralized nature of the cryptocurrencies. They are stateless, they are open, they are completely independent of any financial regime or any political regime. Now, can I just ask a quick question of the audience? How many of you hold cryptocurrency?
Oh, it's got to be more than that.
Come on.
Or is it illegal? The governor is watching.
So, well, we obviously both have cryptocurrency. I hold cryptocurrency partly because I run my business with it, but also because it's a long-term investment. Like any other asset, it might go up, it might go down, but in many ways it's hedging against the volatility of currencies, of standard currencies. And something that you'll see in places like El Salvador or even Lebanon, where we're working, is that it's actually more stable than the local currency. So that would be one reason. But frankly, a lot of the reason people invest in cryptocurrencies, which is a perfectly valid reason, is speculation. Because as an investment asset, over time, I mean, yes, it's incredibly volatile, but over time it tracks upwards.
So maybe we even go a little deeper into this, which is to say, what is the difference? Why would I want to use a digital currency as opposed to just a regular currency? What are the benefits it brings? Stability, other, speculation, stability, whatever. Put that to one side. But why don't I just use a dollar or a Qatari rial or a pound if I'm feeling particularly masochistic?
So unless you are actually standing in a shop with your wallet in your hand and a banknote and the shopkeeper is right there, using cash is actually really difficult and expensive. It's also not very stable in terms of risk, in terms of security when you're moving it around. It's also quite expensive. So a great friend of mine, Dave Birch, always talks about, why do we have big denominated notes and who actually uses them? Who are they really useful for? And the obvious answer is, well, money laundering and criminals.
Yeah, drug dealers, isn't it?
Yeah, basically. Yeah. And the reason it's useful for those people is because you can't trace it. Yeah. Now, a CBDC, as a digital currency, is a traceable asset. It's also a unique asset. So each note, each coin is separate from every other coin. So you can actually trace, as a central bank, where all of it is. Now that obviously has some political and social connotations as well, but in that sense it's much more secure. The other thing is that it's really expensive taking cash around, and all of us are paying for that. All of us are paying for that through our taxes, whereas with a digital currency, you're not paying for the infrastructure and for the armed guards and for the vans taking it from place to place.
But what's the difference? So if my daughter calls me up and tells me that I need to send her £800 to buy a new pair of shoes, which she does quite, I just, other than saying no, I just get out my phone, I make a few taps on my HSBC app and send her £800 for her new shoes. Now, to me, I haven't used any cash. That's, it's a digital platform that I'm using. What's the difference between that, which a digital pound that goes from my account to her account, and a digital currency?
Okay, let me demonstrate. So, if I could ask everyone just to quickly close their eyes.
Me included. Okay.
Okay. And
you give me this.
right now, for anyone who was closing their eyes, and I can see most people weren't, you don't know how that pen got into Richard's hand. Yeah, I passed it to Richard, but only I and Richard know that if your eyes were all closed, which they weren't. And that's how banks work. And when I was working in banks, we would often have reconciliation problems and we'd just alter the balances because something went wrong. You can do that in a bank because nobody other than the bank can see what's happening in the bank. Now, you've all got your eyes open, and now you can all see that Richard passed that pen back to me, and that's like a blockchain. You're all like nodes on a blockchain. So there's a record of that transaction on every single node, which means you can't fudge the account, you can't change the transactions, you can't change the records, and that makes it very, very secure. There's also, of course, from a CBDC perspective, the fact that it is a liability on the central bank's ledger. So you're not facing the risk of HSBC collapsing. Now, obviously, it's unlikely that HSBC will collapse tomorrow, but it reduces that exposure to bank money.
Right. So I think we've done quite a good, 36,000 feet view on the differences here, and what we're going to talk about now is go a little bit more of a deep dive into the CBDC side of things and see how that works. So, Sophie, tell us about these pictures, the applications for wholesale CBDCs and the securities. What are we talking about here?
Sure. When we think about CBDCs, we tend to think about retail, and that's basically what we're talking about today. But there are also applications for central banks and for commercial banks, and indeed for commercial bank wholesale customers, where a CBDC can be extremely useful. And the reason it's useful in that context is because it reduces settlement times. You can take out pretty much any of the cross-border settlement or any of the wholesale settlement times that you would normally associate with these trades, because you don't need to have that handshake between different institutions in order to validate that the cash has moved across. So that makes it easier, it makes it cheaper, and in fact, if we look at Germany, BaFin is thinking of reducing the money supply in Germany because of the amount of risk that can be saved due to central bank digital currency settlements. And then when we look at securities, apart from the settlement opportunity, there's also the fact that when you're using these kinds of currencies, you can trace that currency all the way to the use of proceeds. So you, as an investor, have much more confidence about where the money's going. Now, in some countries, that traceability is not so popular, but certainly some of the countries where I work. But on the whole, it's much better for banks and for their customers to know where that money is going.
So is it fair to summarize it? So it's just a better way of doing, not just, but it's a more efficient, lower risk, lower cost way of doing what we're already doing?
Absolutely. I mean, blockchain has many, many applications beyond the financial world, but from a financier's perspective, it's just more efficient, it's cheaper, it's more secure, and it's less risky.
Before we go on to the next slide, so Toby this morning was talking about ESG, and you also referenced it under the crypto slide just a little earlier. Do CBDCs have the same energy problem or environmental problem that, say, a crypto coin does of something?
Thanks, that's a really good question. So it's obviously everyone knows that Bitcoin burns the planet, and so does Ether. There are different types of protocol, and without getting too technical, Bitcoin and Ether as sort of first generation blockchains both use something called proof of work, which is by design energy intensive. The reason it's by design is to create this trustless and distributed environment. However, more recent protocols are much less energy intensive. So for example, the blockchain that we use is something called proof of stake, which doesn't have this huge energy consumption and therefore is not only less environmentally damaging, but also cheaper and quicker.
Yeah, so it doesn't have to be. It doesn't have to have these mines, with masses of specialized computers. So we've established that CBDCs are the most wonderful thing since sliced bread. But are they real? Do people use them?
So if we look at where they're being used today, this is a map of the countries that have launched them, piloted them, and are doing research. Now, I would point particularly to China, where although that's yellow because it's technically a pilot, there are actually 2.5 million consumers using the Yuan digital app at the moment. You can use it through Tencent, you can use it through Alipay, Now, if we had 2.5 million consumers in Qatar using it, that's more than your adult population. So you could say that's a pilot. I would say that's pretty much in use. Also in the Bahamas and 5 other Caribbean countries, and indeed Nigeria, have already launched their retail CBDC. So it is in use in those countries already. One thing that I would say about particularly the Chinese issuance is that they are so far ahead of the rest of the world. Europe's behind, the US is behind. Basically everyone's behind. I mean, I remember in 2017 when I was writing my last book, and China had 300,000 blockchain developers already, which is, I mean, back then it was just crazy. So they are way ahead. Having said that, their CBDC is not yet blockchain-based, but it will be soon.
Right. Does it matter that they're way ahead? I mean, because it's going to be a Chinese currency. I mean, will we not be able to trade the digital yuan in London, will we, or is it?
Well, the US is taking it seriously enough that they have just issued a proposal that they're going to ban all American apps, online commerce apps, from using it.
Right.
Because they're worried about it encroaching on
land of the free.
Land of the free. But they're worried about it encroaching on US sovereignty, and they're quite right, because although technically it is just in use in China today, that doesn't stop other people buying it. And what I see in Africa, all over Africa and in some parts of Europe, is dollarization. And indeed Euroization, if you go to West Africa, because those currencies are more stable than the local currency. And of course, at a macro scale, if your consumers can get foreign currencies more easily than they can get their local currency and their digital, then the risk of currency substitution is very significant.
Okay, so let's just talk about retail CBDCs. Mm-hmm. We looked at the wholesale, we looked at securities, we looked at the use case for that, which I think is probably in the area of most of the people in this room. But I think your contention is that the retail side of this is where the real step change is. So why don't you talk to that and explain to us wholesale and investment banking types why we should pay attention to retail, which is something we are frightened of and don't understand.
Well, it's building on what I just said about accessibility and availability. If people can hold your currency in a digital wallet as a store of value and use that to transact with, they are more likely to do digital transactions. Now, there are 2 fundamental choices about how you design a CBDC. There is something called account-based and something called token-based. And the main differences between this is an account-based CBDC is basically like your debit card. It will have a balance, and that balance will relate to a number of units of CBDC. So remember, real coins sitting at the central bank. But the key thing there is that in order for you to use that wallet, you have to be validated, you have to have passed KYC, and in order for that to be validated as you do a transaction, usually you have to be connected. The difference between token-based is that it's the asset that is being validated. Just like a banknote with a number on it, that means that anyone can use it. And that means that anyone may use it, which obviously has some implications for things like AML. But just like normal money, you can also put processes in place in your commercial banking sector to track people's behavior. And that's easier when you're dealing with a CBDC because it's digital, because you can track it. The advantage of a token-based system is that you can pay anyone with it. They don't have to have a bank account, they don't have to have past KYC, and that means that it's much more useful. You can use it offline as well.
But so if we're using a token-based system and the person that you're trying to pay doesn't have a bank account, what is it that they receive, and how do they have ownership of that thing that they receive?
Yeah. So they don't have to have a bank account, but they do have to have some kind of digital wallet.
Right, okay.
And if we look at the different structures here, on the left-hand side, you've got the account held by a central bank in a token-based structure. As you can see, this is relatively simple. The central bank issues the coins. Anyone can hold the coin. They can transact with the coin. And it's not, that transaction is not written to the central bank's ledger. It doesn't have to be because they're just moving the money around. Mm-hmm. Whereas on the right-hand side, we have accounts held by the commercial sector. And in many ways, this is a better structure, even though it looks more complicated. And of course, it looks very much like our current retail banking system, current payments. The reason it's better from a commercial perspective is that most central banks are not geared up to do high-frequency retail trade payments and to hold and manage accounts for people to do all the KYC. So what we're seeing in most cases is the picture on the right rather than on the left. And that does require some new actors in the ecosystem. There's a question of whether you invite fintechs to be part of it, as they have in the Bahamas, which is good for financial inclusion. But then you also need some kind of processor who can relate to the central bank's ledger and pass that information on to the commercial banks. So it's much more similar to our current structure in that the commercial bank will hold its own ledger and that will relate to the central bank's ledger. The difference is that it's not fractional reserve, and we expect this to run in parallel with the standard fractional reserve system.
So before we look at sort of global and your particular interest of financial inclusion and all of that, we've got about 6 minutes left. We're in Qatar, as we all, I think, know. Why is this a good idea? Might this be a good idea for a small, wealthy, dynamic economy like Qatar to have their own CBDC? What benefits would it bring to this country over the short, medium, long term?
Yeah. So the main benefit it brings is innovation. I mean, a CBDC allows you to do things with money that you couldn't do before, even with digital money. So, for example, CBDCs support micropayments, and that means if you want to innovate retail, particularly online retail, in terms of micropayments to producers and artists and things like that, that's very easy to do. It allows you to distribute small amounts of rewards, either as an airdrop to your citizens or on the basis of some kind of customer distribution. But I think one of the really exciting things is when you look at cross-border and we look at the opportunities to interact with other countries who are already issuing their own CBDCs and the trade advantage it gives you as a country. So really everything from amazing fintech innovations all the way down to just doing your cross-border more efficiently can be huge opportunities. I mean, my personal favorite is actually bonds because it takes so much of the effort out of bond issuances. You can fractionalize bonds. Anyone can invest in bonds. It really does democratize ownership of bonds. And I think in a country like Qatar, that creates an amazing retail opportunity for your citizens.
Okay, that's very good. And I think we've now got exactly 5 minutes left. So tell us a little bit about how this relates to what you do specifically in terms of financial inclusion and in terms of emerging markets that might not have the infrastructure that Qatar has.
Thanks. Yeah, I mentioned airdrops of money, and that's something that CBDCs are extremely well suited for. It can be used for universal basic income. And what we've seen, especially over COVID in the last few years, is a lot of governments, not just in developing economies, issuing checks to their citizens. Just imagine if that was completely traceable and you could see where the money was going. You didn't have to wait for somebody to cash a check at a bank. Obviously, it's more efficient as well. From my perspective, it also offers the opportunity to overcome the digital divide. And this is something we've seen in the Bahamas, where they've engaged the fintech sector as issuers of the digital currency. And obviously there is still the need to have access to some kind of digital service. But what we've seen in the Bahamas and what we do on our platform is we lower the barrier. Rather than keeping a high barrier for KYC, we lower the barriers to entry and reduce the access level for certain services. So in the Bahamas, you can only pay a certain amount per day, you can only hold a certain amount in your wallet if you don't meet full KYC. I mean, from our perspective, we go a bit further because we've designed a system where people can have a digital wallet without having a phone. But that's not really relevant here. So, yeah, I mean, it does open out the ability for your citizens who may not have full access to the banking system to own and transact digitally with your currency. And I think that's really important, especially when we've got the yuan coming along.
Now, there's, I remember, I mean, the first Bitcoin document was it 2008? Was
2008 it was first published, yeah.
I have read it, actually. Don't understand a word of it, but I have read it. My maths isn't good enough, so I skimmed it. But since then, there's been lovely cycles in the Bitcoin, but also, this is the coming thing. There are places that will take an app where you can pay in Bitcoin, and we all thought it was going to be adopted. And now the issues and the problems with the energy and all of that, I think it's unlikely that you're going to see a decentralized cryptocurrency take over the world in terms of the new payment system and replace the real and the dollar. But in your honest opinion, do you think that the use case for CBDCs is so compelling, and it sits, as it were, behind the headline financial system? So most people wouldn't even necessarily know that it was a digital real was different from a physical real. Do you think that those types of factors really do support the contention that this will be the way that finance is done in the future? And that's the long question. The short question is, when do you think that future will be?
Okay. So in answer to the short question, I would say that future is already here with China. And it's early days. I would say leave it to the Chinese to figure out all the things that can go wrong. They have the advantage of a very tightly controlled banking system, which really helps when you're doing something like this. Same applies to the Bahamas, small country again. But I would say learn from them quickly. And to some of the other points you made, I always say Satoshi Nakamoto, who wrote that paper, brilliant at maths, terrible at economics, hadn't got a clue what was actually going to happen in the real world.
But he wasn't really advocating for it to happen in the real world in quite the way. Well, I don't know.
She or they saw it as a way to have truly borderless cash payments, which it really isn't.
Yes.
So
fair enough.
Yeah. So I do think it has different use cases in different places. I think in some places where people are 100% banked and everything is digital, the use case is more international.
Yep.
So like here, I would say it's much more of an international and an innovation use case.
Yep.
And one of the great things about being a small country is that you have the agility to innovate. And that can be a huge differentiator. I mean, I find that it's sort of, in the big countries where I work, I can also do that because there's nothing there. So it's a totally different use case, but it's still very useful.
Excellent. Sophie, unfortunately, we have to bring this to a close, but where can people find out more about you, and how do they, if they want to have your advice on their central bank digital currency, or all things blockchain, or all things financial inclusion? Where do we get you?
We are hiveonline.com. We can support you with research and advisory if you're interested as well. So my contact details are there. I'm also on the app, if you have the app for the event, so you can contact me through that if you like. Very happy to take any queries.
Excellent. Will you please join me in thanking Sofie for coming this morning and telling us all these wonderful things?